So good morning to everybody, and here we are again on the Excel file. As you know, today we have to spend some minutes to give a look to the Excel file in which we compare the impact of taxation on closed-end fund and investment firm. This comparison is relevant for European countries in which really you have two options, the option of the closed-end fund and the option on the investment firm. So it makes sense in the European Union countries to run this comparison. On the contrary, in US and UK, in which you have the limited partnership, you don't need to compare different alternatives. However, let's come back to data. You remember that we stopped exactly on this point yesterday. In this Excel file, I create for you two different boxes. The box number one is a table for closed-end funds, and the box number two, the table number two, is a table for the investment firm. The story and the exercise is to insert same data in terms of costs and revenues and to try to measure taxation and fiscal impact for the shareholders of the two vehicles, just to understand what are the differences. In the first part of the Excel file, as you remember, I inserted the input data for Italian taxation, so numbers that you have to know. Obviously, you have taxation for closed-end funds, which is a flat tax, you remember, a flat tax of 12.50%. On the other side, we have participation exemption, where participation exemption is relevant for investment firm that has to invest in equity. Let's give a look now to numbers. Let's start with the closed-end fund story, okay? In the closed-end fund story, we start in January with a certain value of the fund, okay? NAV stands for net asset value, which is the value of the closed-end fund in a certain time. So in this case, the closed-end fund starts with a value inside of 1,000. Second, we highlight three different revenues we find in the closed-end fund in this year, and the three revenues we find are capital gains. Let's imagine 250, where capital gains means shares that I sold on the market and I had a capital gains, okay? I decided to exit from some investments and I have a capital gain of 250. I insert dividends, probably is very big as a number, but however, I inserted dividends for 45, and obviously I inserted also interest because let's remember we have a lot of cash which is in the custodian bank, and obviously we take also interest from the very big amount of cash we have. In terms of costs, I insert simply losses. Let's imagine we decided also to sell shares on the market, and we didn't have simply capital gains, but also losses. If you want, you can insert also management fee, what you like, but just simply to focus on revenues and costs. So these are revenues. This is the only cost we have, and the difference is 280. It's okay till now? What happened? What happened is another story, because revenues minus costs is the difference between cash in and cash out I had in a certain year. It's okay? But in the same year, it happens also another story, and the other story is the variation of the net asset value without revenues and costs. Okay? These are two different stories. From one side, you have revenues and costs because of the money you spend and because the share you buy and sell. Okay? This is a story of revenues and costs. But on the other side, you have also a variation of the net asset value because the value of the shares you have in your portfolio is floating. Okay? And for this reason, I insert as a value of the net asset value at the end of December, 1,300. Okay? That means this is the value of NAV at the end of the year, 1,300, plus the difference between revenues and costs. This is the net asset value at the end of December, that means the operating profit of the closed-end fund is 580, okay? Operating profit is the sum of the difference between revenues and costs plus variation of the net asset value, okay? In good times, the variation is positive. In bad times, the variation could be also negative, okay? For example, in 2009, the expectation for all the closed-end fund is that the net asset value probably will floating, but with a negative sign, not with a positive sign. It depends from the economic cycle, obviously. Is it okay till now? The problem is, if this is the operating profit, 580, we have to apply taxation rate, and the taxation rate is the 12.50% of the operating profit. That means 72.5. That means the net asset value at the end of the year after taxation is 1,507.5. Okay? For closed-end funds, the only issue which is quite important to remember is that, please remember there is a flat tax. It's very simple. But please remember to insert in the operating profit not only the difference between revenues and costs, but you have also to insert the variation of the net asset value. Okay? And you have to pay taxes on it. It's okay? Try to understand a very simple issue, okay? It could be a bit tricky, and you have to know. Obviously, in the mechanism of the closed-end funds, when you apply flat tax, there is a sort of double taxation, you understand? For what reason? Because in this case, there is an increase of the net asset value, and you have to pay taxes, okay? Let's imagine the year after you decided to sell these shares, you will have capital gain, and you have to pay taxes on the capital gain. It's a sort of double taxation, because first of all, you have to pay taxes on the variation of the net asset value, and second, you have to pay taxes when you put in your pocket the capital gain. What's the reason of this double taxation? It's a natural trend, but on the other side, regulators don't want to avoid this effect. For what reason? Because the flat tax is very low, and that's the reason why to have a double taxation, it could make sense because of the very low taxation rates, okay? But please take care about it, because it's really a sort of double taxation. Obviously, because we live in a real world, not in theory, okay? The temptation, not the temptation, the natural effect is that managers of closed-end funds try to underestimate the variation of the net asset value, okay? It's a sort of window dressing approach. For what reason? Because you don't have any incentive to say, this year the net asset value variation is not 1,000 versus 1,300, okay? But my incentive is to say the variation is 1,000 versus 1,100, okay? I don't have an incentive to increase and to justify a very, very big variation on net asset value. For what reason? Because for every variation I have to pay taxes, so I don't have the right incentive, okay? I can say it's a very soft game between the managers and the regulators, okay? The temptation is trying to stop the increase of net asset value, but you cannot do it in a very strong way, because otherwise you will have problem of control coming from authorities for taxation. It's a sort of very soft equilibrium between the right incentive and the control of regulators, okay? However, take care, and that's the reason why when you read numbers of closed-end fund, sorry if I'm so rude and cruel, but when you give a look to numbers of closed-end funds and you are the investors, the net asset value is not so relevant for you. For what reason? First of all, because you know that your managers has no incentive to indicate a very high net asset value. Second, because for you it's more important to know the name of the companies in which I'm investing, the value of capital gains I put in my pocket, my strategy in investing in the company. The net asset value, it's okay, but it's not so relevant. And you perfectly know that the bigger is the net asset value is, the higher is the taxation I have to pay and you have to pay. Okay? Please take care about it. It's okay? Just to remember, is not so important now, but just to link to the concept of yesterday, let's imagine that we stay at the end of the closed-end fund. Obviously, this capital gain, if you are a private individual, you can put it in your pocket without paying taxes in Italy. You remember, private individual investing in closed-end fund, don't pay taxes. The same story also for, you remember, foreign legal entities. So foreign legal entities that invest in closed-end fund, let's imagine that 500 is the capital gain you put in your pocket without taxes. But it's not the story. What I would like to do is to compare the net asset value of the closed-end fund with the net asset value of the investment firm. And now we have to discover the story in the investment firm, which is honestly more difficult. It's also more complex, the table. Take care. Let's start. But the first part of the story is obviously the same like a closed-end fund. You see numbers, net asset value of the investment firm. Okay, 1,000. The revenues, capital gains, dividends, interest, and costs, okay, which are losses. Revenues minus cost, 280. It's okay? Numbers are the same because we want exactly to compare the same number to measure taxation efficiency of the two vehicles. Take care. 280 is a number we can use for taxation in closed-end fund, because in closed-end fund we have a flat tax. So revenues minus cost, that's it. Okay? In investment firm, I have to run other calculations which are related to what? To participation exemption. Okay? We have to modify numbers because we have to consider participation exemption impact. Let's give a look. Capital gains. Capital gains for participation exemption are relevant in which percentage? 5%, subject to an holding period which is higher than 1 year and a half. In this exercise, please take care, 250 became 12.5, 5%, if these capital gains came from shares in which the holding period was higher than 1 year and a half. You see? 250 becomes 12.5, that 5%. Dividends are relevant in which percentage for participation exemption? Again, 5%. And so we have 2.25. Interests, obviously, are 5 because interests are out of participation exemption. Participation exemption is for capital gain and for dividends. But that's quite important because your revenues are not yet 250, 45, and 5, but your revenues, which are relevant for taxation issues, are 12.5, 2.25, and 5. And costs, which are losses, you remember? Losses are 0 for participation exemption, because in participation exemption, remember, you have a lot of benefit for revenues, but you don't have benefit for losses, okay? You don't have. Please take care, because this penalty, this punishment is only for losses. If you have other costs, like management fee or interest you have to pay on your debts, these costs are relevant. Okay? That means in this case, the difference between revenues and costs is not 280, but the difference, you are very, very lucky, is 19.75. You see? I would like to check if everything is okay, guys? It's okay? Please, because I would like to check with you what I mentioned before. Losses, you cannot use losses because it's participation exemption. But in case you have other costs like management fee and like interest, because it's an investment firm, you could have debt. Management fee and interest, don't worry, you can use these costs. Okay? Come back to the table. You remember that in a closed-end fund you have two stories, a story of variation of the net asset value and the story of costs and revenues. It's okay? Net asset value without costs and revenues, it's like in the closed-end fund, 1,300. Exactly the same, you see? The net asset value plus revenues and cost, it's obviously like in the closed-end funds, 1,580, and the operating profit is a 580, like in a closed-end fund, but the difference is that the operating profit for taxation in investment firm is not 580, but the operating profit for taxation is 300 plus 19. That means the operating profit relevant for taxation is 319.75. I repeat, the operating profit relevant for taxation in the closed-end fund was, guys, the sum of variation of net asset value plus difference between revenues and costs. It's okay? I would like to check. It's okay? In investment firm, it's the same story, but the difference between revenues and costs is calculated following the participation exemption rule. You see? That means the difference between revenues and costs relevant for participation exemption is not 280, is 19.75. That means the operating profit relevant for taxation is the variation of net asset value, 300, plus the difference between revenues and costs, which is not 280, but is 19.75. Because you are lucky and you are using participation exemption. The taxation on 319 is, the taxation rate is not flat tax in this case. You have to pay taxes like whatever kind of companies in Italy, which is 31.40. And so your taxation, the taxes you have to pay are 100 point something. Okay? That means net asset value is 1,479, and this number, in this case, is lower than the number we find in the closed-end fund. You see? In this case, if you want to compare the efficiency of the two vehicles, in this case, the result is better for the closed-end fund. If you want to give and to say something general, why the closed-end fund is the winning one in this comparison? Why is the winning one? Or if you are a consultant, you are my consultants, when it makes sense to use an investment firm? Try to be my consultants. If you are my consultant, I have to use the closed-end fund. This is the result. If yes, subject to what conditions? Give me some advices. The closed-end fund is the winning one in this case, because of the very, very strong variation of the net asset value. If there are variations of net asset value, there are no story, because the winning one is the closed-end fund. For what reason? Because a closed-end fund pay a flat tax. So if you have variation of net asset value, the taxation rate is 12.50, right? In the investment firm, when there are variations of net asset value, you cannot use the participation exemption, and you have to pay 31.40. The investment firm is perfect when you can use the participation exemption. But if your strategy is to keep your shares a lot in your portfolio and to generate a lot of value years after years, a closed-end fund is better. Okay? So if you want to summarize something, a closed-end fund in terms of fiscal issues is probably a perfect vehicle, but subject to some conditions. And the two conditions are, first, a closed-end fund is perfect when you follow a strategy of a long stay in the company. If your strategy is to stay for a long time in the company in which you invest, a closed-end fund is better. For what reason? Because when you stay for a long time in the company, year after year, there are increases in net asset value. And in a closed-end fund, you have to pay 12.5%. In investment firm, 31.40. Okay? Second, a closed-end fund is perfect when your strategy is very quick, where quick is buy and sell. Because if you follow a strategy on buy and sell, in the investment firm you have a problem. And the problem is an holding period which is shorter than 1 year and a half. So closed-end funds are perfect both for very quick strategy of investment and for very, very long-term strategy of investment. Investment firms are perfect when you don't find yourself in these two stories. You don't follow a strategy of buy and sell. You follow a strategy of buy and hold, but the duration of your investment is not very long. Okay? Otherwise, closed-end funds are more efficient in terms of taxation. Okay? This comparison, and I would like to stop, obviously ceteris paribus, because investment firm can benefit for another competitive advantage which is not related to taxation. What is the other competitive advantage of investment firm? Guys,
Leverage.
it's time that you remember everything now. Leverage. Obviously, investment firm can benefit from a completely different competitive advantage, and this different competitive advantage is represented by the leverage, okay? Because in investment firm, you can leverage your investment. That means you can multiply the amount of money you can invest. Okay? Please take care about these numbers and about this example in which you apply the different concept of taxation. Okay? Questions about it? It's okay? Great. Now what you have to do, we have to change the story and we have to say, okay, we know everything about legal framework and we know everything about taxation, and now it's time to jump into the private equity markets. Okay? So we have to give a look to private equity markets. To give a look to private equity markets means two different stories. The story number one is very easy, and it's a story of numbers. That means, okay, now you know everything about definitions, clusters, players, legal framework, differences between European Union and Anglo-Saxon system. Okay, it's time to give a look to numbers of private equity in order that you start to know what is the size of the market, what is the number of players, what are the characteristics of players, and so on. Okay, it's time to do that. it's better to do this and to face and to discuss about this topic now, because in the lesson number 1, it's very, very unuseful to discuss about numbers of private equity. Now you know everything about the tools, and it's time to give a look to numbers. To give a look to numbers, it's interesting for 2 different reasons. The reason number 1 is that you know the size and the characteristic of players, and second, you start knowing the criteria that authorities, association, and practitioners use to classify and to run statistics about private equity. So it's quite useful to know the language of statistics of private equity market. This is the first part of market analysis. The second side and the second story of market analysis is related to strategies. That means, okay, you know everything about the vehicles, but it's quite interesting to discuss a bit about the strategies and the positioning of the different vehicles inside the different markets. So these are the 2 issues we have to discuss about the market analysis of private equity. For the story number 1, and for me it's a tragedy, I have to use slides, okay? Because we have to crunch numbers, so it's the only lesson in which I have to use slides, okay? Because without slides and to write numbers on the whiteboard, okay, probably it's a nonsense. So we have to use slides and to start to analyze data of private equity market. I create for you a set of slides which is very, very updated. That means you find data of 2007 and 2008, which are quite fresh about private equity, so I think it's quite interesting to have very, very updated data. What kind of data you find in the set of slides? Obviously, it's not relevant for me for now and for the exam, that you keep in your memory numbers, obviously, okay? You don't find questions in the exam in which I ask to you what is the percentage of startup in the United States, okay? It's not relevant. What is relevant, obviously, is that you understand the trends, the different characteristics of the different market. That's quite important, so it's not relevant that you remember exactly numbers, but the trends and the different characteristics, obviously, is absolutely necessary. What kind of data you find? I classify and I insert in the slide 3 different chapters. So the first chapter is related to a sort of market intelligence in which we will find data about the size of private equity phenomena. Size of private equity phenomena means, obviously, the size of the market, the number of players, the characteristics of the players. You know everything about legal framework. Now it's quite important to know the number of limited partnerships in the United States, their size, their volume, and so on. So the first chapter we have to discuss about is on the market. The second chapter is related to trends in investment and divestment. That means, okay, let's give a look to numbers in terms of investment of the different vehicles, and let's start to understand what are the volume and the trends in terms of exit strategy for the private equity investor. And last, the chapter number 3 is devoted to analyze trends in performance and something about the fundraising. That means, okay, what is the internal rate of return for the private equity all around the world? And second, what are the financiers? That means people that decide to invest in private equity vehicles all around the world. These are the chapters I would like to discuss with you. For me, it is important not simply the content of the tables, but also the criteria and the common language we use to run statistics for the private equity market, because we will discover conventional rules, and it's fundamental to know conventional rules to run statistics, especially for performance, in which if you don't understand, you don't know the conventional rules, really it's became very dangerous for you because of very big misunderstanding. But however, let's start to discuss. This is the chart 1 I would like to discuss with you. Before jumping into numbers, I would like that you understand the method and the criteria. Okay? So, first of all, it's important, this story. In this chart, and in all the charts you find in the set of slides, I inserted 6 different countries. So, US and UK, and now you perfectly know the reasons why I insert US and UK, the 2 very big markets in the world, and blah, blah, blah. I insert also other 4 countries, which are the most important countries in Europe in terms of private equity activity, obviously, and the markets are Germany, France, Italy, and Spain. So 2 Anglo-Saxon countries and 4 countries coming from European Union. Take care about one issue. We never discuss about it, and it's time to do that. I insert Germany in this position between the Anglo-Saxon country and between the European Union country, because there is a reason. Germany, for private equity, now, is really a country in transition. For what reason? It's a quite interesting country for private equity, because Germany belongs to European Union, obviously, and follows all the rules of European Union. That's perfect. So we probably find a lot of numbers in Germany which are exactly the same of the numbers in Italy, France, and Spain. But from 5 years, Germany decided to follow a very smart strategy. And the smart strategy is to say, we perfectly know that the private equity is a financial service, and we have to follow European rules. But we perfectly know that in US and UK, the story is completely different, okay? Because we want to follow a very smart strategy, we give the option to the players in the markets to decide if to follow the European Union rules or to follow rules which are more or less the same of US and UK. So in Germany, you are very free to invest using a closed-end fund and investment firm, but you are absolutely free to use another vehicle where this vehicle, sorry, I'm not able to speak in German, so my pronunciation is very bad. So sorry for that. But it's possible in Germany to use another vehicle which is exactly the same of a limited partnership, where in Germany is named KG. Okay? KG, I'm not able to pronounce the very long name in German, so sorry for German speakers. Sorry for that, you have to help me, okay? But KG is the name of the vehicle, which is quite similar to a limited partnership you can use in Germany. What is the issue? The issue is that in Germany, if you want, you can use closed-end fund investment firm. Please follow European Union rules. But if you want, you can use a civil code vehicle, which is the KG, where the KG is exactly the same as a limited partnership. But if you use the KG, the German limited partnership, I'm very sorry, you are out of the financial system. That means no control, no supervisor authorities, no internal code of activity, but please apply the same story, the same framework of the limited partnership in US and UK, okay? It's a quite tricky strategy because in this case you are very, very free to select the proper vehicle to invest. So this is the reason why I insert Germany between US and UK and the European Union, because for some certain aspects, numbers are very similar to Europe. For other aspects, numbers are very similar to US and UK. That's the reason why I insert it. Sorry for the very, very long introduction, but it's very fundamental that you know. In the chart number 1, you find numbers of players at the end of 2007. It's not possible in this case to have more fresh data, okay? They are the most fresh data we can find on private equity. In this column, I inserted the name of the vehicles. Let's give a look to the name of the vehicle. Closed-end funds, limited partnership, investment firms, banks, public-private vehicles like, for example, SBIC in the United States, and the total. Okay? In the column, you find numbers, so please give a look to the European group. So closed-end funds, Germany, France, Italy, and Spain. Okay, 75 closed-end funds in Spain, 89 in Italy, 111 in France, 90 in Germany. So closed-end fund, the leading vehicle to invest in private equity in Europe. Limited partnership, we don't find limited partnership in France, Italy, and Spain, but we find 102 limited partnerships which are KG in Germany, you see? So in Germany you have both closed-end funds, and you stay in the financial system, and you have limited partnership, KG, and you stay out of the financial system. Investment firms, 35, 29, 60, and 33. Please take care, because in this table you find the number of investment firms, 106 and 107, okay? Is not possible to have a perfect statistics about investment firms which are 122, okay? Because the disclosure is not so strong, and in many cases it's very difficult to say if the vehicle of Stefano, which is 122, is devoted to private equity or to something else, okay? So when you see statistics about investment firms, please remember these statistics are for vehicle 106 and 107. We don't have cross-country statistics about 122. We have, with a very different quality, country statistics about 122, okay? But take care about the usage of investment firms, 106 and 107. Banks, what is the rationale of this number? In this case, you see 4, 7, 10 banks, because in these statistics, you find only the number of banks that has a very specific division devoted only to private equity. And this is quite uncommon, even though most of the banks in their portfolio has some private equity investment, but in these statistics we highlighted only the banks which has a very focused and specific division devoted to private equity. And last, public-private vehicles, Germany, France, Italy, and Spain. We have sometimes very small vehicles created at a regional level that invest in private equity. US and UK, the story is different, because US and UK limited partnership are the most important vehicle, 343 in United States and 163 in United Kingdom, okay? Take care, sorry, because you have to know. In Europe, numbers of vehicles are absolutely right. For what reason? Because vehicles are supervised, okay? So if we see in Spain 75 closed-end fund, it's the right number because closed-end funds are supervised by Bank of Spain. It's okay? In US and UK, limited partnership are not supervised. That means we don't have official statistics coming from regulators, but we have only statistics managed by private association of limited partnerships. You understand? So 343 and 163 are the numbers of limited partnerships which belong to association, private association of venture capital fund. This number is right, is wrong. Probably this number contains the most important players, but is not a right number. Probably we have also other players, but if they don't belong to an association, it's impossible to have statistics about these limited partnerships. Okay? Just another issue, and also like the Germany story, is the first time for you. Closed-end fund. In United States and United Kingdom, obviously, we don't have closed-end funds, okay? Take care, because in terms of statistics, we have some numbers. 59 in US and 123 plus 22 in UK. It's just simply a usage of labels, okay? Don't worry. We don't have a closed-end fund in the United States and United Kingdom, but we use the label in statistics of closed-end fund to identify other phenomena. Let's start from United States. 59, in the parentheses you find only fund of funds. What does it mean? When a limited partnership invests not in private equity, but invests in other limited partnership, we use the label fund of funds. That means it's a limited partnership which doesn't invest in private equity, but invests in another limited partnership to diversify the risk, okay? In this case, we use the label, which is not a legal one, fund of a fund, and in terms of statistics, fund of fund are considered like, closed-end fund. So don't worry, we don't have closed-end fund, but we use the label closed-end fund to identify fund of fund. I know it's very complex, but in official statistics, we find this usage of labels, and you have to know. In United Kingdom, we have 22 fund of fund, where fund of fund, again, are limited partnership which invest in another limited partnership. But please remember, in United Kingdom, we have 123 venture capital trusts. Sorry, it's not 123, it's 323. I have to, please, it's a mistake. 323 venture capital trust, okay, which in terms of labels are considered like closed-end fund, okay? 323 venture capital trust. It's okay? Investment firms, sorry, life is difficult for you. 0 investment firm in United States. In United Kingdom, we have 30 investment firms. Why we have 30 investment firms? We have 30 investment firms because United Kingdom is out of the financial services system in Europe, but if UK people would like to use vehicles which are compliant with the European Union laws, they can do that. And for this reason, in United Kingdom, we have evidence of 30 investment firms, which are 106 and 107, because in this case, some British investors decided to use a vehicle which is compliant with the European Union system. It's time to discover a lot of issues and stories about regulation and private equity. Banks, okay, some cases of banks, and last, public-private vehicles, where, take care, in the United States we have 73 public-private vehicles, which in the United States are small business investment companies. So in the United States we have 73 small business investment companies. Okay? This is the first picture. I spent a lot of energies on this table because it was useful to highlight some very minor details, but which are quite important to understand private equity. Just the last remarks, not for the exam, but for those of you who would like to run a thesis or research project or would like to discuss about private equity in the future. The two blocks, US and UK, and Europe on the other side, are very different also in terms of quality of data, okay? In Europe, we are supervised, and it's very easy to have data about private equity because closed-end fund investment firms must be approved by the regulator. That means in terms of number of players, in terms of characteristics of the player, it's very easy to have data set and information about vehicles. US and UK, vehicles are not supervised, So we don't have official statistics coming from regulators. We have only private statistics coming from private associations of private equity investors. For example, the 343 limited partnership belongs to different associations in the United States. So if you want to have statistics, you don't have to give a call to the Federal Reserve, because the Federal Reserve doesn't know anything about private equity, because it's out of the financial system, but you have to give a call to the two associations of private equity investors in the United States. So statistics are private, and they are not official, because they don't belong to a regulator like in Europe. So take care about these two stories, which are an obvious consequence of the big assumption private equity is a financial service or is not a financial service. Chart number 2 is exactly the same of the chart number 1, but you have simply percentage. In the chart number 1, you have number of players, it's okay. In the chart number 2, you have percentage of investments by different players. Also in this case, data are updated at the end of 2007, okay? Let's give a look to the chart. France, Italy, Spain, closed-end funds represent more than the 50% of the market. You see numbers? Closed-end fund covers more than the 50% of the market. 0% limited partnership, investment firms, 20% in France, 25% in Italy, 27% in Spain. So really, we find the two players, investment firm and closed-end fund. Germany, it's quite interesting, and it's surprising, because closed-end fund represent only the 25%, and the KG, the limited partnership, represent the 45%. So in this borderline country between, for private equity only, between European Union and Anglo-Saxon system, the answer to the option which is given to the player is better to use a limited partnership than to use a closed-end fund. Because in Germany, the 45% of volume is managed by a vehicle which is very similar to the limited partnership. US and UK, limited partnership is the leading vehicle, 58% in US, 45% in United Kingdom, but take care in US, we have another 15%, which is managed again by limited partnership, but this limited partnership act as a fund of funds, you see? That means in US, the volume managed by limited partnership is 73%, but take care, 58% they are limited partnership and 15% they are fund of fund. That means limited partnership, which can invest, because it's written in the LPA, only in other limited partnerships. UK, 10% fund of fund. That means 45 plus 10% is more than the 50% limited partnership, but 20% venture capital trust. Venture capital trust. Please take care, because in United Kingdom, venture capital trusts are more than 300. But the volume of investment is only 20%. For what reason? For what reason the number of venture capital trusts is higher than the number of limited partnership, but volume is smaller of venture capital trust? We have to come back to the definition.
It's devoted to the retail.
Yeah, because venture capital trusts are devoted and they are focused only on retail investors. So venture capital trusts are quite popular. We have an amazing number of venture capital trusts, more than 300, but volume are lower than limited partnership because investors are by law only retail people. So very popular, but in terms of the size of money is obviously smaller. Last mention for public-private vehicle in the United States, Small Business Investment Company covers the 19% of the US market. So remember this percentage. What is missing from this table? You have really to start crossing everything now, because it's time for you. What is missing in this table?
Business angels.
Business angels, absolutely. In US and UK, business angels is missing. For what reason? Because when I mentioned business angels, I said business angel is a quite important phenomena, but we don't have any evidence in terms of statistics. So till now, it's not possible to run statistics about business angel. We have only estimation, but it's a nonsense to insert estimation in a table in which compare different countries. So business angels are missing because we don't have official statistics, like also corporate ventures. Okay, you remember in the United States, also corporate ventures are relevant, but I'm very sorry, we don't have official statistics about that. That's the reason why we don't have evidence of this data in the table, because it's not possible to have. Okay? This is quite complex, please.
Why in Germany the percentage of private and public partnership is so low? Because I know that, for example, in Germany, the states has usually a big percentage of ownership in companies.
It's a very smart question, so really thank you very much. The answer is a bit tricky. When I say public-private vehicles, I mention, and everybody mentions in the words, vehicles which are created using a special law, to allow private and public investors to join together and to invest in private equity. The example is SBIC, okay? But another story is public investors, like governments, would like to invest in private equity, and they invest in closed-end fund or in limited partnership. It happens, yes, it happens, but if a public authority, like, for example, World Bank is the most important case. World Bank invests in many funds all around the world, in closed-end fund in Europe, in limited partnership in US and UK. Yes, but in this case, when you have a public authority investing, the public authority invests in closed-end fund, limited partnership in which you want. I write public-private when we use a vehicle which is created by a special law, like SBIC, okay? But when a public investor invests in a vehicle, invests in a limited partnership or in a closed-end fund, like whatever other vehicle, okay? Just for example, I would like to link, when you will have in the classroom for the last part of the course, Fabio Sattin, which is founder and president of Private Equity Partner. Private Equity Partner is an asset management company in Italy with a lot of closed-end funds, and among the investors, Fabio has the US government, okay? A public authority that invests in a closed-end fund. It's possible, yes, because it's an investor. But in this case, the vehicle of Fabio Sattin is a closed-end fund, not a public-private vehicle, okay? So thank you very much for the question, because it's really important, but I hope now everything is okay. It's okay? The chart number 3, sorry, a lot of numbers. I would like that you remember only something, again, also in this case, data at the end of 2007. The 6 countries that you know. What we find, number of investments, global size of investments, average number of investment per player and average investment per player. So in this table, you have an idea about the size of the private equity market. Let's give a look to numbers in terms of number of players, number of investments, sorry. Spain and Italy, okay, 443 and 590 investments. Numbers are different in France and Germany, completely different in UK and US, in which the number of investments is very, very different from the European data, okay? Number of investment means giving a look to the portfolio of the players at the end of 2007, how many equity investments they have in their portfolio at the end of 2007, okay? You see that numbers are very, very different. Global size of investment, here you find the size of the market of private equity. You see numbers are dramatically different. If we move from Europe and we jump into US, the size of the market at the end of 2007 is really, really different. Average number of investment per player also is a number that I would like you to remember, because sometimes we have an idea that a private equity vehicle has a portfolio of investment. It's not really a portfolio because the number of investment per player is not very big, you see? 4 investment in Spain, 3 investment in Italy, 9 in France, 5 in Germany, 8 in UK, 14 investment per player in the United States. That means, as I mentioned many times, private equity is a human business, is a time-consuming business. You don't sit and you don't manage a desk activity. Private equity, it's really a work you have to manage with the companies. And obviously, you can manage a portfolio of 5, 6, 7 investments. It's quite impossible to manage a portfolio in which your investments are bigger, because you don't have people to sit in the board of directors, to advise company, to manage scouting activity on your country. So it's tremendously time-consuming, and that's the reason why the number of investment per player is quite small. The last row is quite interesting because you have the average investment per player. This is the average size of the investment for every player of private equity. What we can see is that there is a sort of range. We move from 12 million euros, which is the average size in Spain, to 36 million euros in the United States. That simply means, okay, probably in the United States, investors invest in companies which are a bit bigger than the company we find in the European Union. But this is an idea about the average investment per player, just in order that you have in your mind the size of the numbers of the different players. That's great. Now we have to jump into, after the size of the market and the global picture, it's quite interesting to jump into the story of investments of private equity. In this case, we are luckier because data are calculated at the end of 2008. You see in this chart, data are calculated at the end of 2008 because they were available. In this chart, what we find? In this chart, we find the clusters of private equity that we started knowing in the lesson number 1 of our course: seed and startup, early stage expansion, replacement, and vulture. I'm very sorry, it's impossible for official statistics to have different numbers for seed and startup, and it's impossible for official statistics to have ideas about the distinction inside vulture, okay? So the reason why classifying that way the cluster is that we have only official statistics in this way. Let's give a look to numbers. The numbers and the percentage are calculated in volume. Let's give a look. Seed and startup, percentages are very, very different from country to country. So we move from, I'm sorry, the 2% in Italy to the 10% in France and Spain, again the 3% in Germany, and we find the 10 and the 15% in the United States. So really, really different stories. Why we have different stories, reasons are sometimes very different. My personal opinion is that in Italy and in Germany, but this is my personal opinion, you cannot write it, okay? It's not relevant for the exam. In Germany and Italy, probably we have this very small percentage because both in Germany and Italy, we don't have incentive for startup and we don't have strong incentive for research and development. It's very hard in a country to launch startup and to launch seed project if you don't have very strong incentive for the startup and research and development themselves. In the other countries, like in UK and US especially, you have very strong incentive both for startup and research and development, and that's the reason why we have very, very important percentage and volume on this sector. Early stage, also in this case, percentages are quite different because we move from the 5% in France just to get to the 15% again in the United States. Expansion, on average, it's quite similar. Remember that it's the easiest cluster of private equity. Expansion, and we find data ranging from the 30% in Spain to the 15% in France and United Kingdom. Replacement, as you know from theory, is the leading cluster of private equity. So give a look to volume. We range from the 40% United States, where, take care, inside 40, the 38 is LBO. So only the 2% is not LBO. 56% in United Kingdom, 58 in Germany, 50 in Spain, 67 and 65 in France. So really, really, you can see that replacements, and especially LBO method, it's really the cluster of private equity, as I mentioned many times. Probably next year, in 2009, that's my opinion, data will be different. Will be different for two reasons, because the volume of private equity will be smaller and probably the leading cluster will be not replacement in terms of LBO, but we'll see at the end of 2009. In 2008, this is the story in terms of volume. Vulture, in Vulture we have really very, very different numbers. 0% in Italy and Spain, that means there are two markets in which Vulture really has to start. France and Germany 5 and 7, UK 4%, Vulture financing United States is 10%. Probably data of 2009 will be different because Vulture financing, because of the big crisis, is becoming more and more important. Probably also in this case, data will be different, and the expectation is that many volumes of replacement will be removed to Vulture finance. Okay? What I would like to highlight of this chart is a last remark. We find different stories, we find the cluster, but what I would like that you remember is that in United States, which are the most important markets of private equity, we can say that we don't have a cluster which is the most important. Yes, replacement is very important, but if you give a look to data, in the United States, the private equity is developed into different clusters because we have 15 in seed, 15 in early, 20 in expansion, 10 in Vulture. That means in the United States, we find a market for every cluster. That's the very important characteristics. In the other country, with the exception of United Kingdom, but in the other country, there are something which is missing. Let's give a look to Vulture. Let's give a look to data of seed. Okay? Some clusters are partially or totally missing. And this is a very, very disadvantage for those countries, because if you have all the clusters, it's easy for private equity investor to enhance and to support better the economic system. Because if you have a very strong seed, when seed investor decided to exit, they sell the shares to startup investor. When startup investor decided to exit, they sell the shares to early stage, and so on. But when some clusters are missing, it's very difficult to manage the job, okay? Because money are focused only in some specific sectors. The Italian case or the French case, let's give a look. 65 and 67%, which is focused on the replacement. That means this is the clusters of private equity, all the energies, all the investment, all the very good people are devoted to work in replacement, and we don't have energies to manage other clusters which are relevant for the country system. So this is investment for investment cluster. Another chart, probably it's a bit boring, sorry for that, but I would like to give a look. In this case, again, at the end of 2008, I classified volume of investment considering the size of the company in which you invest. I classify, statistics classifies data considering investing not per cluster, but per cluster of target of the company using the size of the company. In this case, you see that even stories are different. The typical cluster for private equity investment is a cluster in which a company has sales ranging between 50 million and 250 million, okay? It's the classical target for private equity investment. In the United States, the same percentage also for bigger companies, where in Europe probably is not so relevant, but what is important is that this is the classical target. If size of the companies are lower, you see that also percentage became lower. Let's give a look to these two clusters of company, between 0 and 2 million euros, and companies with sales ranging between 2 and 10. Also in quite developed markets like US and UK, you see investments, but they are not so relevant like the other clusters. What is the reason? For you as a private equity investor, it's very risky to invest in very small companies. Or you want to gamble your money because you invest in a company with 2 million euro sales, and your gamble is to say, this company will be a company of 100 million euro sales in 2 years, and it's okay. But if I invest in your company, which is 2 million euros, and the expectation is the sales of your company will be 10 millions in 2 years, I'm very happy for you. It's a very good company, but it's a nonsense for me. For what reason? Because we said many times, when you manage private equity, you have fixed costs. And the energy you have to spend for the company of your colleague, 2 million euros with an upside of 10 millions, are exactly the same if the expectation of growth of your colleague is to get to 100 million euros. My energies, my time, my costs are exactly the same. So I invest in small company only if there is a very clear expectation of a very strong growth. Otherwise, it's a nonsense for a private equity. But it makes sense for business angel, okay, for business angels, not for private equity investors. This is a tremendous table, very small numbers. I don't want to discuss about the content, but simply you remember the rationale of this table. In this table, again, at the end of 2008, the 6 countries, I classified the sector of the different companies in which you invest, okay? So you find industrial, telecom, transportation, chemicals, biotech, medical services, and blah, 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 okay? The different sectors which private equity investors invest. I don't want to jump into data. What I would like that you remember is that in US and UK, we don't have evidence of a leading sector, of a target sector. But in US and UK, private equity investors invest in all the sectors. On the contrary, in Europe, we have evidence of two sectors, because in Germany, France, Italy, and Spain, if I consider industrial sector plus services, these two sectors cover more than the 50% of the investment. That means in Europe, the strategy of private equity investor is more traditional and conservative. We invest in traditional sector like industrial sector and services sector. On the contrary, US and UK, we don't have a leading sector. We find investment in industrial, yes, in transportation, in chemical, energy, biotech, medical, internet. No difference. All the sectors are okay. In Europe, a more conservative strategy, okay? So it's very hard to find investment in biotech or medical like in US and in UK. Okay. This chart, I'm sorry, is quite new because we never discuss about it. We have to discuss about it next week and in the second part of the course, when you will discuss about the deals of private equity. But I would like to spend 2 minutes to give to you for the first time an idea about this table. What we never mentioned till now is private equity is a great tool, but please remember, if you want to have capital gain, you have to sell the shares. Lesson number 1, okay? You have to exit. From a logical point of view, the way of exits are not so much. If you are a private equity investor and you want to sell your shares, you don't have a lot of options. So in this table, you find the names of the options you have if you want to exit and the percentage in terms of volume. That means, let's give a look to the different exiting strategies that we follow all around the world. I don't want to discuss about theory now. Labels are very simple in order that you know from a logical point of view what are the different exit strategies and the percentage we find. The exit strategies are only 4. Trade sale. Trade sale means I sell the shares to another company, where another company could be a competitor, a shareholders of the company itself, another shareholder. For example, trade sale is very common in replacement financing when we have to manage turnaround. You remember in turnaround, what's the problem? The problem is I invest in a company because I have to solve a corporate governance issue, okay? What is my exit? I will sell the shares to an existing shareholders. In this case, we have a trade sale. The other story is the IPO or the sale post-IPO. That means to exit from an investment, I launch an IPO and I sell the shares in the IPO or post-IPO. The strategy number 3 is a sale to investors. That means I sell the shares to another private equity investors. And the last, a very sad story, the write-off. That means I'm not able to sell the shares and I have to manage a write-off because of the default of the company or because it's not possible to find another buyer. You have to insert also a last row, which is called other. Other, it doesn't mean that there are other solutions, but simply means in the statistics that it was not possible to classify the exit way. I'm sorry for that, it's not elegant, but it's the real world of private equity. In this chart, because otherwise the sample, statistics are a bit biased, because in 2008, we didn't have any IPO all around the world. In this case, statistics are calculated on 3 years, 2006, 2007, and 2008. Is better because you have an idea about the world of private equity. 2008 is completely biased because we don't have IPO, and also 2009 we don't have IPO. And also it's very difficult to have exit in 2009. All the investors keep the shares inside portfolios because it's very hard to sell shares to other people, okay? For this reason, I create for you a table 2006, 2007, and 2008. In this case, I classify the different exit strategy in terms of volume, So trade sale, 20%, 30, 25%, Italy, France, and Spain. Trade sale is a bit uncommon in the United States. IPO or sale post-IPO, very important in US and UK, not important in Germany, quite important in Italy and Spain. So in this case, there is a very strange story for Italy and Spain in which there is a very strong usage of IPO. The reason is very simple. In Italy and Spain, there was a boom of the stock exchange market between 2006 and 2007, and also private equity investors decided to use a lot the stock exchange, while on the contrary, in Germany, the stock exchange is not so developed, and that's the reason why private equity investors really don't like to use the stock exchange to exit. I would like that you remember this row, sale to investor. Sale to investor means I sell the shares to another private equity investors. This story covers the 40% in US and UK. For what reason? Because in US and UK, we have a lot of players. We have a lot of players in all the clusters. And in US and UK, it's very common that you are a startup investor, you sell your shares to an expansion investor. It's very common because you find it. In Europe, you have the shares, you want to exit, but sometimes you don't find the other private equity investors. That's the reason why in US and UK, volume are quite high, volume are quite low in Italy, you see, 10%. On the contrary, it's interesting in Spain, volume are again quite higher. There is also a story of write-off, where write-off are not small numbers, okay? And we stay in 2006, 2007. Yes, we have also 2008, but probably in the future write-off will be higher. Let's give a look to numbers. Write-off are 8% in US and UK, 10% in Germany, 15% in France, 15% in Italy, 10% in Spain. That means write-off is a part of private equity, okay? It's not simply a golden tool in which you invest and you produce capital gain. Private equity is always a story in good times, not in bad times, but private equity is always a story also of write-off. And you see number, write-off means if you are not able to manage, for this volume, your internal rate of return is minus 100%. Please remember. And to have minus 100% means you destroy the performance of your portfolio, you destroy the expectation of your carried interest and of the return for investors. So write-off really are a part of private equity. In 2009, the expectation is that this number will increase a lot. And for this reason, many players in 2009 don't want to exit. They keep their shares in their portfolio and they want to wait because it's not time to exit. Otherwise, losses, risk of write-off, very small capital gains. You can do that if you are lucky, because if you stay in the extra time, for you, it's not possible to wait. Let's imagine a closed-end fund that decided to use the extra time in 2006. Now you don't have time and you have to exit, even though you stay in bad times. If you are lucky and you have other 3, 4, 5 years, you can wait. But if you stay in the extra time, in 2009, it's a tragedy for you and for the investors. Okay? This other chart is exit in terms of numbers. What I would like to do now in the last 10 minutes is to discuss about performance and fundraising, the last chapter I would like to mention. Performance. Before giving a look to numbers, I would like that you know an empirical rule, an implicit rule in statistics of private equity. If you don't know this rule, it's a tragedy to analyze and to understand numbers. When you see tables all around the world that mention the internal rate of return of private equity, please take care, because in 99% of cases, but it's written in the table, the IRR is gross pooled IRR. When you run statistics, IRR are gross pooled. What does it mean, gross pooled? Let's use a number. For example, 2007, United States, the gross pooled IRR in the United States is 51%. A very interesting number. What do you see? What do you say about it? It's okay? Yeah, but take care, is gross pooled. Gross pooled means to calculate 51, the conventional approach is, let's give a look to the exit that happened in 2007 in the United States. Okay? Let's give a look to the exit that happened in the United States in 2007. So, company A, company B, company C, and blah, blah, blah. Okay? It's okay? Let's calculate the internal rate of return for every investment. Okay? So, investment A, 150%. Investment B, 2%. Investment 3, 18, and blah, blah, blah. Okay? No, take just a moment, just a moment. So we identify the exit in a year. It's okay? For every deal, we calculate the internal rate of return. This internal rate of return is yearly. But we don't consider internal rate of return coming from write-off. We don't consider internal rate of return coming from write-off. For what reason? The reason is very simple. When you decided to manage a write-off, let's imagine, today, March 17, I decided to write off the company of, your name is Marco, okay? The decision is March 17. In your opinion, today, it's possible to calculate the internal rate of return on the investment of the company of Marco. Today, decided to write the write-off. It's possible to calculate the internal rate of return today? No, because today I decided to manage the write-off. That means I have to start to manage a recovery process. I try to use, if I have some collateral, I try to sell some assets. I try to negotiate with Marco the usage of his personal wealth. We probably discuss for 1 year, 2 years, 3 years, and only after a long time it's possible to say on the investment of Marco, the internal rate of return is minus 65%. Okay? It's a long process, the write-off. For this reason, in the official statistics, we say, okay, we consider the yearly internal rate of return for all the exits which are not write-off. For write-off, it's not possible to calculate the internal rate of return. From one side, it's correct, but on the other side means these numbers are completely biased, because when there is a great number of write-off, obviously these numbers are biased, because 51% in the United States means a very good performance, but we don't have any ideas about the impact of the write-off. And also in 2008 and 2009, data calculated in this way probably will be positive. Not very high, but positive. For what reason? Because we don't insert in this method the internal rate of return which are negative coming from the write-off. Guys, I don't want to say it's a good idea, but simply take care, because in official statistics, this is the method which is used. The last issue, the IRR is gross and pooled. Pooled, because we consider all the investment in a year, is gross for two reasons. The reason number one, we don't consider write-off. The reason number two is gross, because, obviously, we don't have any evidence of the management fee and the carried interest. So the performance is gross. It's not the performance that you will put in your pocket at the end. Okay? Because on the 51%, you have to pay the management fee and you have to pay the carried interest at the end. So it's gross for these two reasons. No write-off and no evidence of the management fee and the carried interest. It's okay, guys? I would like to check if it is okay, really. Let's imagine an investment in which we say performance is 18%, okay? Let's imagine 1 year, in order that we don't run calculations. So 1 year, 100, okay? It's okay? The gross pooled IRR is 18%, right? It's okay? But let's imagine that in this closed-end fund, there are only an investment. What is the amount of money you will have in your pockets? The amount of money will be 18 minus the management fee, right? Management fee, let's imagine, is 2. So money are 16. On 16, we have to calculate the carried interest, right? Let's imagine the classical formula of carried interest. 30% of the difference between the final internal rate of return, which is 16, minus 18%, right? The 30% of this difference is the 30% of 8, where the 30% of 8 is, let's imagine, 3. So the gross performance is 18%. The performance for the investors is 13%. So take care, because I don't want to say that this table is wrong, but simply remember this table is a table of the performance of the private equity vehicles, is not a table of the performance of the investment of investors in private equity. It's a table about the performance of private equity vehicles, which is not the performance for the investors. The performance for the investors is lower because of the write-off, because of the management fee, and because of the carried interest. I don't want to say it's a bad deal. It's not a bad deal, but take care. One story is performance for vehicle, another story is performance for investors. The last chart, only 1 minute, and we come to an end, it's interesting, is a table about investors. Who are the investors of private equity? Also, in this case, the table is calculated on 2008. The 6 countries and the name of investors. Name of investors, it's the traditional way to classify investors in private equity, are banks, pension funds, fund of funds, corporate investors, insurance companies, private individuals, government, others. you see that in the different countries, you find different story. For example, in Germany, like your colleague mentioned, if I remember that your colleague mentioned Germany, he's talking with another colleague now. Government in Germany, for example, represented 10%. That means for vehicles devoted to private equity in Germany, 10% of investors are governments. Insurance company, for example, 18% in France. What is amazing, in my opinion, is the role of pension funds, 22% in US, 24% in UK, 15% Germany, 13% France, 20% Italy, and 14% Spain. So really, really a lot of players which invest a lot. It's interesting also the role of private individuals. Also private individuals invest in private equity. Percentage are not very, very big, but however, the maximum is in United Kingdom, in which the 9% of investors in private equity are private individuals. This is useful for you to have a breakdown of the different names of the different investors, not because you have to imagine some very strange trend, but simply to know what are the names of the investors and what are the different percentages we have. Okay, I think we can stop. So we see you again next week, for last week before the exam.